Dr. Johnson, do you want to ask a question?
Yes, I would like to, if you don't mind.
I think a microphone is coming to you.
Okay. I would like to take a little exception to the lender of last resort liquidity argument. I'd be the first to say that once you're dealing with the cards you're dealt and you're in the middle of a crisis, then the lender of last resort function, liquidity provision, is very important, and you have to deal with, systemic financial risk the way, with all the resources you can. But I think the problem with that, with assuming that, okay, the Fed needs bottomless powers for lender of last resort, is that you're casting a moral hazard over the whole system. And so, yes, it's important to have in a moment of systemic crisis. But how did you get to that crisis in the beginning? I think the big problem there, we could avoid those problems in my mind, and maybe I'm just too old school, but I think you can avoid those problems in the beginning if in the good times you're paying more attention to the effect of moral hazard on market pricing. And I think the more you expand the potential for bailout, whether you say or not the bank has a stigma for going to the discount window or borrowing or not, and you don't use it, doesn't matter, because it's affected the overall market cost of funds. Once the market is convinced that the central bank is going to bail out every failed institution, every failing institution, it affects the global cost of funds. And whether you know it or not, you're just going into the market facing the cost of and purchasing money at the most effective rate you can. Well, if it's subsidized, you're going to take it. You may not know it's subsidized, or you may not assume it is. It is. It's assuming the whole system is bailed out. And once that happens, you're going to get investment cycles. You're going to get over-investment cycles. Now, in the first panel, somebody said, well, we don't know whether there's a bubble or not. And you probably don't specifically know where the bubble is, although I'll say this. It wasn't very hard to know there was a bubble in mortgage finance. That was not a very difficult problem to see. How? Because Congress had subsidized it for decades. The cost of funds for mortgage finance was unbelievable. How did that happen? It happened because of a safety net and the subsidization through taxpayer money of mortgage expansion. Now, we've cast this safety net over everything. Now, I'm not saying it was a bad thing. It probably had to be done with the cards that were dealt at the time. But I think there was a massive regulatory failure in seeing this coming. And if prices had been, if risk had been priced more accurately, you may not have ever had to face this problem. And I think that if we continue to think, well, the answer is just simply extending the liquidity provision ability of central banks to deal with crises, and the market assumes, well, everything is subject to bailout. There's nothing excluded. So let's just price it that way. Then the system is doomed. It's just doomed. And I think that's my broad comment. It's pretty old school, but that's the way I see it. I mean, I say this as someone who was heavily involved at the Fed when we had the largest stock market crash in human history. I was right there, and I know how that feels. But the fact is, the fact is that one of the things that helped us in that case was the notion that everything wasn't bailed out. Yeah, we provided promised market liquidity to those sectors of the market that had access to the safety net, but thank God everything didn't. So anyway.
If I may react to that, maybe.
Sure.
I think what I at least meant, and I'm very interested to hear what your view is, but what I meant is not to replace the bail-in by the lender of last resort. For me, it was a liquidity support. And we in the Institute of International Finance, we are very much in favor of bail-in. We don't like bail-out. But there can be circumstances, and I was just giving that example of a cybercrime crisis with payments, where there's a system event which with a lot of unrest, where then it could be used as a sort of a bridge facility by the central bank. I didn't mean to replace it. We are all in agreement that the bailout should not be repeated. It should be bail-in, and bail-in by doing all the TLAC type of instruments. So we are very much in favor of it. For me, it's indeed just in stepping in for a bridge facility so that we don't have disorder in the system.
A couple of things. First of all, Dr. Johnson, I totally agree with your emphasis on we should do whatever we can to make sure we don't get into this situation. And the more we can do along those lines, whether it's better bubble detection or more capital, whatever it is, I'm totally in favor of that. But we've had financial crises around for a long time. I'm maybe more old school than you on that, and I don't think they're going away. Okay, it's kind of an endemic feature of financial systems. So we do the best we can up front, ex ante, but we have to be prepared, okay, for the situation where it doesn't work and we're in a panic and we have contagion. That's point one. So we need a strong lender of last resort in those situations.
Can I just point out one thing on this, though, that, and I don't disagree with what you're saying, but and I'm not sure everybody's, I'm not sure everybody, likes the old Bundesbank approach, but I thought they had it right in a lot of ways in terms of, one thing you do, and it always worked well with central banks, in my opinion, especially the Bundesbank, and in some ways I wish the Fed had some of those older models now, and that is that they did a good job of saying, well, we're vegetarians, and we never eat meat, okay? So you'll never find us bailing anyone out or making any exceptions. We're vegetarians and we'll always be vegetarians. And then you walk in one day and you see somebody, the head of the Bundesbank, is eating a cheeseburger, and you say, well, wait a minute, I thought you've declared you've been vegetarians for decades, You even raise interest rates sometimes when the market doesn't seem to justify it. He said, well, I am a vegetarian, but everybody likes a cheeseburger once in a while. I mean, and so what I'm saying, and my point is, you have to convince the market that there's discipline in the system, so that macroeconomic pricing more correctly prices risk. Then, if there's an exception that requires an emergency, then you deal with it. But that is not expected. Once it is expected in general in the marketplace, everything is screwed. So.
All right, why don't we turn to another question? You guys have been waiting patiently.
Well, I'm Steve Miller, and I'm actually the director of the Johnson Center for Political Economy at Troy University, which exists because of Dr. Johnson here. But I could pile on, but I'm going to change the subject a little bit, which is one concern that I have in all of this, and this is just kind of looking at it abstractly a little bit, is that if there's this concerted effort to raise regulatory barriers, to clamp down on all sorts of risk, clamping down on risk like that and creating all of these barriers to risky lending, which is essentially what lending is, so just keep making less lending happen, what effect must that have on monetary policy and the effectiveness of the Federal Reserve, just even in terms of open market operations, or perhaps when they're trying to do quantitative easing, disagree or agree with those tactics, when they're just trying to conduct monetary policy to fulfill even just half of the dual mandate, right? How can that work? I mean, what we saw with quantitative easing was we saw that there was a big increase in the money supply, but it never worked its way into the economy. There was just excess reserves were pumped up, essentially. You didn't see price inflation. Not only did you not see price inflation, you didn't see big increases in lending really anywhere. So how can monetary policy even work? The thing that the Federal Reserve, that a central bank is actually supposed to do, how can that work if they have clamped down on all risk everywhere?
Does anyone want to weigh in on that?
You want to talk? I mean, I think this is it's an issue, and we've seen this in the discussions that were referenced before about bond market liquidity. Where the Fed is both. Is on both sides of the issue. And that's, again, the Volcker Rule. What is the Volcker Rule going to do, not just to the bond markets, but to other markets, derivatives and things like that. So I agree it's an important issue. It's one of these things that the regulatory system will just have to calibrate going forward. I mean, I thought you were going in a slightly different direction. I thought you were going to talk about the effect on the real economy, and that's where I'm really, that's in a sense where I'm more worried, right? There's some people, there's this view of, look, the crisis was so bad, so any regulation is fine. There's no cost-benefit test or anything past the cost-benefit test. And I think you still need to push back against that view.
Yeah, and I mean, I think that draws the connection between the first panel where we talked about
Exactly.
risk-taking being a natural part of economic growth and innovation, and this panel, which, regulation in the financial area is really complicated because it's hard to figure out how it will affect all those kinds of things.
I think one of the perverse effects of regulation is, that it's forcing activities out of the regulated sector into the unregulated sector. So there's still going to be prop trading, but it's going to go on at Citadel rather than, Goldman Sachs. So what do we accomplish by this? Aren't we going to be concerned if large hedge funds get into trouble? I'm sure we are. They're non-banks. They're becoming increasingly important in the financial system. So it's not like you really cure the problem when you just go down on the banks, okay? Major effect of that is moving activities out of the banking sector into the non-banking sector. So from that point of view, how have you achieved the benefit that you're trying to achieve by this regulation if the risk is still there, it's just in somebody else's organization?
If I may give an example, in Europe they have a serious problem with SME finance, and so they decided that the way to get that in better shape was securitization. So the QE in the ECB takes the form of buying securitization bonds. Why doesn't it work? Well, simply because the regulations make it prohibitive for the originators to go into securitization. So you don't. The price obviously has an impact, but the real structural problem lies in the real loss and defaults in the securitized portfolios and the regulatory capital not being in sync, and then loads of additional overhead costs for all kinds of trade data that you have to provide loan by loan data, which is all fine, but in the end, the business case still doesn't make sense, whether there's QE and the ECB stepping in the market or not. And that is a serious problem now.
John, do you have a question for us?
Yes. It seems in every industry except banking, there's a presumption that relatively free and open entry while still adhering to the rules is good, and that new competitors are good. But ever since the crisis, the attitude of the bank regulatory agencies has been they're basically hanging out a sign that say no new banks need apply. In addition to Dodd-Frank and everything else, there's like a 7-year business plan where a bank has to show it has capital for loans and deposits 7 years from now. And only one new bank charter really has been granted, the Birmingham Bank in Pennsylvania, in an Amish community there. And aside from that, and even going back to the Bush administration, some banks with non-financial companies such as GE Capital were grandfathered in, but there has been both official and unofficial moratoriums on any retailer, manufacturer, other business having a banking affiliate, starting with Walmart in 2006 and Home Depot and a unit of Berkshire Hathaway also applied. In addition to the rent-seeking, banks who didn't want competition, you also had Greenspan and Bernanke, I mean, seemingly oblivious to the dangers in mortgages in 2006. I was saying, oh, this is a threat to financial security as
All right,
separates the banking.
John, I'm going to just cut you off only because I think you have a really important question, and I want to make sure that we get some responses.
How do you feel?
Mike?
I'm just going to say other, I mean, we're unique in the world. Tesco Bank in Great Britain
Sure.
with retailers. Walmart actually bank in Mexico. So we're the only country that doesn't allow new entrants like this or doesn't allow non-financial businesses to have banking units. And
Mike, you want to speak
Yes,
to that?
I'd like to just say, listen, the financial crisis taught us that the largest financial institutions aren't just financial, they're really nuclear power plants. They melt down and they can hurt hundreds of millions of people, and they just require much more rigorous controls, just like a nuclear power plant is much more rigorously regulated than a conventional one, just because of the consequences. I agree with heavy regulation at that end of the spectrum. I agree with the speaker that at the other end of the spectrum, the smaller, there's been a complete overkill. And that's the safer end of the spectrum, as I was saying before. That's where a lot of economic activities generated. You know, banks below $10 billion, I think the barriers to entry have just gotten too high. The compliance costs, it's all out of control. Now, with regard to non-banks being involved in finance, I think that that's probably something we can live without.
We're going to have more of it, though.
Right.
Phil,
It
do
seems
you
like,
wanna-
no, I was just thinking, it seems like Chairman Shelby has put forward proposals to deal with some of this, and right, I mean, there's some political obstacles, but I think eventually a lot of that will go forward, and that's probably a good thing, and part of the calibration, moving away from the overreaction of
Yeah.
Dodd-Frank, and hopefully addressing the point, to some extent, that the question raised.
But I think the having challenger banks is very important. I'm from a large international bank, but I do believe it's very important. And I think in the US, in the past few years, there were 500 banks that went out of business here in the US. And that's simply too much because, to be honest, if you're a farmer indeed in a village, you'd rather deal with the local bank that knows you, understands you, trusts you, than with this large bank that comes in and doesn't know what your business really is or what your circumstances are. So I think it's very important. And I have actually talked also here in the US with smaller banks that basically said, we cannot comply with the regulations, so we'll just go and negotiate the fine. And then we are going and negotiate the fine for not complying.
Fine.
The penalty.
Okay.
Yeah.
So I don't think that is the right solution.
It'd be interesting to figure out why we have not had new bank charters, and I'm sure part of it has been the reluctance of the regulators to grant new charters, and I deplore that. They shouldn't be doing it. But I think probably, given the fact that large numbers of banks are going out of business, the demand for these charters may not be very high. And why aren't they high? Because, it goes back to Sarbanes-Oxley. When we had the Sarbanes-Oxley reform, we noticed that they had disproportionate impact on small companies because they can't support these compliance costs based on the revenues, but they have the same compliance costs as large firms. So we need to figure out, and we in the capital markets, we tried to do something about that with the Jobs Act, okay, in which we treated small firms differently. We relaxed their requirements for IPOs because we thought they couldn't really comply with the normal rules. I think we should have some kind of initiative, and I know Senator Shelby is very interested in this, an initiative along that line.
All right, Peter, you get the last question.
Thank you. Two quick questions, actually. With regard to OLA, the market distortive effects of a tax exemption on the intermediate holding companies, the idea that they don't really get subject to any capital requirements and that they're being funded by the Treasury, ultimately to be backed by bank taxation if necessary. To me, that seems like the best game in town. These banks are going to be banks on steroids. They're going to be stealing market share from healthy banks. Can you guys speak to that? And the second quick question is that if agency and Treasury debt is basically the collateral that is always required in a sense with regard to uncleared swaps and also is heavily incentivized in risk-based capital, are we looking at a crowding out effect with regard to government debt that is actually eating up some of the ability to do business in the private sector?
I mean, I can speak about the first one. I think you've hit the nail on the head on a key issue with Title II, right? If Title II works, losses will be imposed, of course, on the shareholders, but then on the other counterparties, right? Bondholders, maybe derivative claimants, things like that. And again, I have in mind the AIG experience, right? I mean, Title II, you don't have these, sort of, this heated rhetoric about bailing out the, people on the other side of AIG because the authority would be there, right? But if that doesn't work, and then you have to get to the next stage, which is what you identified, that's a failure, right? I mean, that's penalizing the good ones to pay for the sins of the bad ones. And of course, we do that in other contexts, but that will say that Title II hasn't worked, right? And so to me, that's the key, is to make sure that the losses can be imposed on the people who should fear the losses ex ante, and therefore adjust for that in the yield they require to fund, to fund institutions. Right? Just one last thought, right? That's, again, if Title II works, right, then ex ante, the cost of funding will change, right? It'll at least level the playing field, if not go in the other direction of making, large bank funding even more expensive, right? I have nothing against large banks, nothing in favor, whatever the market says. But that would change the economics if Title II works. And you pointed out the situation in which it doesn't, which is a really important point.
Does anyone else want to weigh in?
I've forgotten the second part, so I can't even answer it. So I apologize.
The second part is just a crowding out effect from agencies and treasuries being incentivized so heavily in bank, assets.
Oh, I see.
Yeah, well, that's actually totally true, that you only have a pot of money, so you'll have to allocate it to the high-quality liquid assets. Now, obviously, I'm actually in favor of those buffers, but you have to imagine that here in the US, you have US treasuries, and they're pretty stable, low risk, also low yield, but it's pretty okay. But in many other countries, you force people to hold assets that are not so good because it works per currency, and so you also it's very difficult actually in some jurisdictions to find enough liquid assets that are also of high quality, because in other jurisdictions the markets are simply not that liquid. So it's a kind of a difficult situation outside the US and outside the UK as well, because these are the two markets that do have enough supply of those assets.
Just a quick follow-up, but if that's the case, then in the US you would foresee that there's ample quality company debt, corporate debt, that could act as, in a diversified manner, for example, act as a suitable collateral to replace agency debt or treasury debt. Is that what you're basically saying?
No, because that doesn't qualify.
No, if it were to, if regulators...
Yeah, well, that would be fantastic.
Yeah.
We've been pushing very hard for that, also for equities.
So now I have an answer, which is if you read yesterday's CBO report on the long-term fiscal outlook, you won't be worried about the lack of Treasury securities.
Yeah, exactly.